So welcome to our class today. Our unit is financial accounting. These are the paper that is tested for CASNEP foundation level. It also covers topics that are tested for ATD level 2. They're very, very relevant for ATD level 2. So these are the topics. This is the course outline. These are the topics that you're supposed to go through from topic 1 to topic last. And then you'll be ready for examination. When you sit your exams, after you've gone through all these topics, you'll be able to pass or to do well in your exams. So topic number 1, we have introduction. You have to go through introduction. We'll go bit by bit, the content of what it is that entails introduction. Then topic number 2, we have final statement of a sole proprietorship. Topic number 3, we have bank reconciliation. Topic number 4, we have correction of errors. Topic number 4, we have correction of errors. We'll learn what it means by correction of errors. Topic number 5, we have control accounts. Topic number 5. Topic number 6, we have what we call preparation of final statement on incomplete records. We call them incomplete records. Then topic number 7, we have partnership, preparation of financial statements of a partnership business. Then we have number 8, we have company accounts, preparation of final statement of a company. If you're running a business as a company, how to prepare their final statements. Then number 9 is manufacturing accounts. This entails the preparation of financial statement for a business that is being run as a manufacturing entity. Then we have accounts for non-profit making organizations. You also need to know how to prepare accounts for those organizations that do not exist to make profits. We call them non-profit making organizations. Then number 11 is what we call the cash flow statement. You need to know how to prepare a cash flow statement. And then we will have number 12 is what we call ratio analysis, to analyze the financial statement of an entity to be able to tell how they are faring on. So that one is called ratio analysis. And the second last topic is called fixed asset movement schedule. So this is a schedule that shows the movement of fixed asset. So we'll learn about it in details when we are at that point. Then lastly, we have public sector accounting. So the accounting for public entities and organizations. So this is a course outline. These are the things that you need to know in order for you to pass examination. By the way, for any unit that you're doing for CASNEP that is tested by CASNEP, the first step is you should be able to know what you're supposed to cover from topic 1 to the last topic. Then number 2, you have to have the materials. So we will share the materials. Then I'll take you through the materials, and then you keep on reading and doing more questions on those particular topics. We share more questions. Then when you do that, pass is guaranteed. Pass is guaranteed. Now we'll go into nitty-gritty. We'll start with introduction. So far, I have outlined what it entails, the contents of introduction. The content of introduction, these are the items that you're supposed to learn under introduction, under the topic introduction. So we have the first topic, we're calling it introduction. So these are the contents under introduction. Number 1, you're supposed to know the definition of 2 very important words. We call it bookkeeping and financial accounting. So you need to know what is bookkeeping and what is financial accounting. Number 2, you need to know the importance of accounting or financial accounting. You need to know the importance of financial accounting. Why do we need to study accounting? Why is it important? So that is number 2 item under introduction. Then number 3, you need to know the uses of accounting information. So we have those stakeholders or parties that are interested in financial accounting. We need to know why are they interested and what is their interest in financial accounting. We call it uses of financial accounting. Then number 4, we have what we call qualities of useful accounting information. So accounting information has to have some qualities for it to be useful. So we also need to go through it and be able to know what it is that consists useful characteristics of accounting information. Then we have accounting concepts. What is accounting concepts? So we'll learn about accounting concepts. Then we have source documents. Then we have books of original entry. And then a ledger, and finally a trial balance. So these are the items that you need to know under what we call introduction. So we'll go directly Go directly. We'll start so we are doing introduction. We have already finished course outline. So we are doing now introduction. So now we go directly to definition of terms. So we have what we call bookkeeping. Bookkeeping, what is bookkeeping? Bookkeeping simply means the recording of business transactions, recording of business transactions, business transactions in the books of accounts, in the books of accounts, and keeping the records properly, picking the records. So bookkeeping simply refers to the art of recording business transactions as they occur in the books of accounts and keeping any accompanying documents properly, filing. So that is what it is, bookkeeping. So you simply, when a transaction occurs, you record it properly, and then every transaction in accounting has to have a supporting documents. That document has to be kept properly so that we can have a trail of those transactions that are occurring in a business. So that process of recording the transactions and keeping the accompanying or the supporting documents is called bookkeeping. It's called bookkeeping. So we will share the notes. You can also be able to follow and read through, keep on reading through so that you can be able to master. Then now we have financial accounting. Financial accounting. So what do we mean by financial accounting? Financial accounting. What do we mean by financial accounting? Financial accounting simply means it is recording. You record the business transaction, and then you summarize, you classify them, summarize them, and report them in form of statements such as income statement, statement of financial position, and cash flow statement for decision making. So it goes beyond recording. So after recording, you classify. You say these are sales, these are expenses, these are assets, and then after you've classified them, you summarize them, and then you report them in form of statements such as income statement or statement of financial position or cash flow statement for decision making for business. So it goes beyond recording. So it is after recording, you record. So it involves recording, you record, you classify, and then you summarize and report in form of statements for decision making. So that is what we call financial accounting. So what are the importance of accounting? What are the importance of accounting? What are the importance of accounting? Remember, more detailed notes will accompany the video. So you'll be given once you have the videos, you also be given the notes you can read through, as I have already said. So we have the importance of accounting. Why do we need to study accounting? So there are quite a number of reasons why accounting is needed and the importance of accounting. So there are, number one, so it is to help evaluate the performance of a business, to help evaluate performance of a business. Number two is to ensure statutory compliance, statutory compliance. Number three, communication with external stakeholders. Number four is decision making. Number five is for budgets and planning. Among others. So these are some of the reasons as to why we need financial accounting. Number one is to evaluate the performance of a business in terms of whether the business is making profit or losses. So the business exists to make profits. So the only tool that we have that can be able to tell us whether the business is attaining that particular objective is financial accounting. It will be able to tell us whether the business is making profit or loss. So that is number one. Then we have what we call statutory compliance. It assists the business to comply with the law, to ensure that proper taxes are paid and all the relevant requirements of the governments are complied with. So it provides that necessary information for compliance with the law or the requirement of the law. So that is number two. And then communication with external stakeholders. So we have other stakeholders that are also interested in business, and one of the tools that we use to communicate with those stakeholders is financial accounting. I'm talking about stakeholders such as lenders, such as investors, such as suppliers, and so forth and so on. So they want to know how the business is faring, so that they can be able to engage with the business. We call them stakeholders. So we communicate with them through financial accounting. And number four is what we call decision making. So the business has to make decisions on regular basis. Decisions such as to expand the business, to selling a particular product, to hire new employees, to buy a new asset. Such decisions, you can't be able to make them without proper information, especially on financial status of a business. Therefore, financial accounting gives us that required information for us to be able to make sound decisions. Then lastly, we have what we call budgeting. For us to be able to make projection in futures, to be able to tell trends, and we have to have financial information for us to be able to do our budgets, our planning. So that one, financial accounting provides that particular information that is relevant for that. So that was called the importance of financial accounting. Remember, this more detailed data will accompany the video. Then we have what we call the users of accounting informations. We call them users of accounting information, those ones that are interested in financial accounting information and why they are interested. So we call them stakeholders. We call them stakeholders, those that are interested in financial information and why. So the following are some of the users of financial information. So we call them users of financial information. Users of financial information. So number one, we have the owners of the business. We have the owners. Number two, we have the customers. Or number three, we have the employees. Number four, we have the government. Number five, we have the suppliers. Number six, we have the lenders. And number seven, we have the managers. Number eight, we have the financial investors, etc. So these are some of the stakeholders, or those that are interested in financial information. So we need to know the stakeholder and why they're interested. So we have quite a number, as I have listed down. So number one, we have the owners. In Kenya here, we have different form of business ownership. We have a business that's owned by a sole proprietor. It's called a sole trader business. We have partnership. Then we have companies. So the companies, all of them are form of business ownership. So the owners of those particular business entities, they want to know whether their business is doing well in terms of profit or losses. So the only tool that is available to tell them whether their business is making profit or losses is financial accounting. So they are interested. Their point of interest is to know whether the business is making profit or losses. So that is their point of interest. That's the reason why they're interested in financial accounting. Then we have customers. Customers are those who consume the product or services of particular business entities. Why would they be interested in financial accounting? Customers rely on business for goods and services. So they want to know, to review the financial information, to know whether the firm is stable enough to continue supplying them. So they want to know the stability of the firm for continuity of supply of the product that they consume from the business. Then we have the employees, those ones who are hired to provide services for consideration. We call them employees. What would they be interested? So that they can be able to know whether the business is sound enough for them to continue earning, and number two, can they also use that information to bargain for better working condition and better pay. So for better bargaining for better pay, and whether they should be able to craft an alternative way of earnings if the business is not doing well. Then the government, the government are mostly interested because they want to plan, they want to know, to estimate accurately the amount of taxes they can be able to generate from business entities. So they will be interested in knowing how the business is faring on, so that they can accurately estimate the amount of taxes that they can generate from a particular business. And then we have suppliers. Suppliers, these are entities or individuals that supply goods to the business on credit. So they want to know whether the business is in a position, capability to pay back when they have been sold on credit. They want to know whether the business is in a position to be able to pay for the goods that have been sold on credit. Then we have lenders. Also lenders, they want to know, lenders are institutions or individuals that can provide extra capital in form of loans to businesses in order to undertake their expansion projects or even run their business successfully. So these lenders, they're interested in financial accounting to know whether the business is in a position to pay back. Are they able to pay back? So for them to be able to tell whether the business is in a position to pay back, then they have to have financial accounting information. Then managers. Managers are involved in the day-to-day running of the business. So a manager plans, coordinates, do staffing, and so forth and so on. So for them to be able to do their work properly, for them to be able to plan, for example, they have to plan when they have the financial information. So it facilitates their work of management. Then the investors, finally, they want to see whether the business is viable. It's viable, that it can be able to give them returns, supposing they decide to invest. So they want to know the viability of the business. So those are what we call the users of financial accounting information. So they are these ones that we've outlined. And then the information, further information and details are in the notes, accompanying notes, which we're going to share. Last, then we go to qualities of a useful accounting information. Go to qualities of a useful accounting information. So we have here qualities of useful accounting information. So we have qualities of useful accounting information. Qualities of useful accounting information. So accounting information must have some qualities for it to be of any use to anyone. So number one is what we call understandability. That is number one. Number two is what we call comparability. Number three is what we call relevance. Number four is what we call reliability. And five, objectivity. So those are the qualities of a useful financial information. So it has to have these qualities. Number one, understandability. It is a measure of how easily an individual can comprehend a business entity's financial information reports, not necessarily to whether you have financial background or not. You should be able, when you just analyze the statement of any entity, you should be able to understand them. So they should be made in such a way that they are be able to comprehend. So to understand means, are you able to comprehend? So here we're talking about comprehending. Can you be able to comprehend? So for the information to be relevant, it must be information that it's comprehensible. You can be able to comprehend. Then comparability. Comparability means in the process of evaluating financial information between two periods. Can you be able to put them into perspective from one period to another? Are you able to compare? So in other words, they should provide provision for you, the user, to be able to compare from one financial period to another. Then irrelevant, when you say that information must be relevant, it is an information that can be able to influence a decision, can be able to influence a decision. So we have some other information that cannot, they are irrelevant, they cannot influence decisions. So what do I mean by influence? For example, you're being told that a particular product was being sold in a particular shop or in a particular place yesterday at a very reduced price. Maybe the original price is 1,000 bob. But yesterday, this product was being sold at a half price, 500. So you're being told now, today. So if you bought it yesterday, you will have paid 500. But the information is being relayed to you today when the price has already been switched back to its original of 1,000. So you see, the information that you're receiving today is irrelevant. It cannot help you to make a decision. Had it been told yesterday when that product had been reduced, maybe you have made the decision to go for it. So when you're getting it today, we say that one is irrelevant information. Irrelevant information. So information need to be relevant. It can be able to assist you to influence a decision. Then we have reliable. For information to be reliable, it must be free from errors, and mistakes. Free from errors and mistakes. Information to be reliable, it must be free from errors and mistakes. So the keyword here is free from errors and mistakes. Assuming you want to invest in a particular business, then you're analyzing the financial statement. Then you query or you interrogate a particular figure that is indicated in the financial statement. For example, you are being told that they made sales of a particular amount. Then now when you want to see the supporting documents, you're being told that it was error, it was erroneous. It was erroneous. They are not like that. When you keep on interrogating other figures, you also told they are not properly captured. They are erroneous also. So you see that one will bring the reliability of that particular information into question. So that is what we mean by reliability. Then we have objectivity. Objectivity simply means that information, financial accounting, should be free from personal opinion or should be free from bias. You should report it factually the way it is. Like you can say this company is so big and it has generated a loss in a particular year. So instead of reporting that loss that has been reported, you report a profit based on the size of that particular organization. So you're not being factual, you're being biased. So financial information need to be objective. So those are what we call the qualities of useful financial information. Those are qualities of useful financial information. Those are qualities of useful financial information. Then we have what we call accounting concepts. We have what we call accounting concepts. Accounting concepts. So what are the accounting concepts? What are the accounting concepts? Accounting concepts, these are specific principles that are adopted by businesses in reporting their financial statements. So there are specific policies. A policy is a rule or a guideline that is adopted in reporting financial statements. So it's a policy that is adopted by organizations in reporting their financial reporting. So that is a guideline a policy is a guideline that you use when making financial reports. So that is what we call accounting concept. So it's a policy or a guideline that is adopted, a specific rule, practice that is applied in presenting financial statements. So we have quite a number of them. So number one here, we have what we call going concern. We have what we call going concern principle or concept. Then we have accrual concept. accrual stroke matching concept. Matching concept. Number 3, we have what we call prudency. Prudence concept. Number 4, we have what we call consistency. Consistency. And number 5, we have what we call business entity concept. Business entity concept. Number 6, we have what we call money measurement. Money measurement concept. We have what we call money measurement. And then we have what we call number 7, we have what we call duality. Number 8, we have what we call substance over form. Substance over form. And number 9, we have what we call realization concept. Realization concept. Number 10, we have what we call materiality concept. Materiality, among others. So just a few. We have historical convention, among others. So these are what you call accounting concept. We already explained what it means by accounting concept. So what is a going concern? What we mean by going concern concept? So going concern simply means it implies that a business will continue in its operation in the foreseeable future. That the business is formed to continue in perpetuity, not to come to an end. That the business will be in existence in the foreseeable future. A business is not coming to an end. So when you read any financial statement of an entity, you know that that entity is still in operation, not that it's coming to an end. There's no intention to curtail or to bring to an end the operation of a particular business. That is what it called going concern. The business will continue in operation in the foreseeable future. In the future, the business is not coming to an end. That is what it called a going concern concept. And then we have what we call matching or accrual concept. Accrual concept, very, very important. It means that the business must recognize expenses when incurred and not when they are paid for, and recognize revenue when they are earned, not when they are received. So we can incur an expenditure in a particular year, but we don't pay it in that year. We pay it in the subsequent period, the subsequent year. It doesn't mean that it should now be recognized as an expenditure for that year. For example, we have year 2023 and we have year 2024. So there is an electricity bill that was incurred in 2023, an electricity bill that was incurred in 2023 of a particular amount, say 10,000. Of a particular amount, say 10,000. So this amount is being paid for in 2024. Is being paid for in 2024. This is the payment year. It doesn't mean that this is now an expenditure for 2024. No. That is an expenditure. It should be reported in the 2023 when incurred. So we match it with its period. Then you can also have a rental property where you are letting out for tenants and they're paying you rent. So there's a particular year, you earn a particular amount. Maybe we also have 2023. You're supposed to be paid 1 million shillings. You're supposed to be paid 1 million shillings in 2023. But the tenant did not pay in that 2023. They instead paid in 2024. It does not mean that now that one is going to be recognized as income for 2024. No, it is going to be recognized in the period that it was earned, which is 2023. So that is what it means by matching. Matching means we matching or accrual concept. We record expenses or we recognize expenses in the period incurred, not when they are paid for, and we recognize income when they are earned, not when they are received. That is what we call accrual concept. Then we have what we call prudency. Prudence means that the business should not overestimate the value of their assets and the value of their profits. Instead, they should recognize the loss of value of the asset as because of repeated usage. Then they should also recognize expenses that are likely to occur so that now that their profits should not be overestimated. So we're here at consistency. So we need to understand what it means by consistency. Consistency is analyzed in two forms. Consistency is two forms. It's analyzed in two forms or two ways. It means when preparing financial statement, similar items should be given similar treatment. Similar items should be given similar treatment, and the same treatment should be applicable from one accounting period to another. The same treatment should be applicable from one period to another. For example, we have different methods of valuing stock. So we have opted for a particular method. We should use that method on all stock items. Then the same method should be applicable from one accounting period to another. We should not use this method this year, and then next year we're using another method. That is not what this concept advocates for. It advocates for similar treatment of similar items, and the same method should be applicable from one period to another. That is what we call consistency. If you have chosen a particular method of depreciation, for example, we have various methods of depreciation. We have reducing balance method. We have a straight line method. So if you have decided as an entity to use straight line method as a method of depreciation, all the items, that method should be applicable. And then that method should be applicable from this accounting period to another. We should not now be able to use different methods in one period to another. That is what we call consistency. That is what is called consistency. And then we go to this other concept. We call it business entity. This entity, it means that there should be separation between business transactions and private transactions. So there should be no mixture of private affairs and business affairs together. Whatever it is that is business and whatever it is that is private should have a very clear distinction. We should be able to tell this is not for business and this is for business. Even for sole proprietorship, we should be able to distinguish between business transactions and private transactions. There should be a separation between business transactions and private transactions. Then we go to number 6, we call it money measurement. Money measurement, we go to another accounting concept, we call it money measurement. Money measurement simply means that items that are recorded in financial accounting, items that are recorded in financial statements should have some monetary attribute. We can be able to attach some monetary value to it. For example, we have some other good qualities like hardworking. We have some other good qualities like hardworking, loyalties, etc. Those attributes, we cannot be able to attach some monetary value to it, and therefore, because of that, we don't record them in financial statement. We cannot be able to record that we had very hardworking staff workforce in our business. Although very, very good, but it cannot be recorded because it has no monetary attribute. When we buy an asset like a chair, for example, that chair, it has some monetary value to it. Therefore, that one can be recorded in a financial statement. So that's what it means by money measurement. Then number 7 is what we call duality. Duality simply means that in every business transaction, it is of twofold. Every business transaction is of twofold, and that is the basis of double entry recording of transaction in accounting. So we'll learn what it means by double entry, but at this point, just for the purpose of explanation and understanding what it means by duality, it means that in every business transaction, it has to be of twofold, and that is the basis of double entry. Double entry, the basis of double entry, the basis of double entry. Then we have substance over form. Substance over form. Substance over form, it means we record items in financial statements or books based on their economic reality, not their legal form. We record transactions based on their economic reality. Economic reality and not and not their legal form. Not their legal form. What do I mean by that? When you buy an asset, for example, on hire purchase is where you pay deposit and the remaining amount you pay on installment basis in bits until you complete the entire payment. So for the assets to be recognized in your name. So now when a business acquires an asset through hire purchase, legally that asset is not their asset until they pay the last installment. But economically, it's assisting you to generate income. Therefore, it should be recognized in your financial statement as an asset. So it should be reported as an asset. But legally, it is not until you pay the last installment. So it does not mean, so when it comes to recording, we're going to record it as an asset based on the current economic reality, So we recognize or we record items in a financial statement based on their economic reality. That is what it means by substance over form. Then we have another concept, we call it realization. Realization simply means revenues are only recognized after they have been earned. We recognize revenue when earned, not when anticipated. So there is what we call anticipation. You anticipate or you estimate that you're going to make sales, and therefore you just record sales and revenue in that matter. For example, there's an inquiry from a particular customer. Just an inquiry. Based on the inquiry, you go ahead and record that particular as sales. No. We only record it when the customer has already made an order and we have already delivered the goods. We have already earned that particular sale. So that is what we call realization concept. That is what we call realization concept. Then lastly, we have materiality. Materiality simply means that we only record those items that can influence decision making in an organization. So we recognize or we record those items that can be able to influence decision making. For example, I'm using this pen here in my writing here. So very, very important. Without this one, we might struggle in our learning. But with this one, it can be able to facilitate our learning. It makes it easier. I can be able to demonstrate, write on it. But now supposing where I am, that is a school. They want to sell that particular school. So this one will not be an item of recognition. It will not be reported in the financial statement of that school. They cannot be able to report marker pens in their final statements because this item cannot influence the decision. But although very important, but it's inconsequential in terms of decision influence. So therefore it will not be recorded. So materiality differs from one organization to another. It depends. In one organization, 1 million can be an issue. In another one, 1 million is not an issue. They cannot waste time in trying to record where this million went or is. So it depends on the size and the nature of transaction. So that is what we call accounting concept. This is what we call accounting concepts. We have accompanying notes that will be able to enhance your understanding of this particular area. We're going to share the notes with you. That is what we call accounting concepts. So we are now on item number 6 in our outline of the introduction. So we're talking about the source documents. So what are the source documents? These are documents that gives evidence of occurrence of a transaction gives proofs or evidence of occurrence of a transaction in business. So it's a document that gives evidence of occurrence of a transaction in a business. So every time there's a transaction, there must be an evidence that that transaction occurred. So they're very, very important. If you're going for an interview as an accountant, you must be able to know these documents, these source documents, their work and how they are applied in a business. Very, very important. So we're talking about documents such as, number one, we're talking about an invoice. Talking about an invoice. Number two, talking about credit note. Credit note. Number three, a debit note. Debit note. Number four, a receipt. Number four. Number five, a delivery note. A delivery note. Number six, we have quotation. Quotation. Number seven, we have petty voucher, and among others. So we have quite a number, but for the purposes today, we only learn about these ones. You can read more on them. We've only isolated or identified a few very important that you need to know, but essentially, it's very important that as an accountant, you must know all the source documents. You must know all the source documents. So we start with an invoice. So what is an invoice? An invoice is a document that is sent by the buyer to the seller when goods are sold on credit. It's a formal document that is sent by the seller to the buyer to request for payment when goods are sold on credit. So a formal document that requests for payment when goods are sold on credit. So it is sent by the buyer to the seller to request for payment when goods are sold on credit. So it gives a brief description of the goods sold, the quantity involved, and the amount. It also has the address of the seller and the address of the buyer, So in simple words, it is a formal document, that requests for payment when goods are sold on credit. That's a document. So we have incoming invoices. Those ones are originating from suppliers when they sell on credit to the business, and then we have outgoing invoices. Those ones are sent by the business to the customers, whom we call debtors. The business name for credit customers is debtors. So that is an invoice. I hope you understood it. Then we have a credit note. A credit note is a document that is prepared to correct an overcharge on an invoice. It's a document that corrects an overcharge on an invoice. Sometimes when you're preparing an invoice, you can overcharge the customers, either due to errors or many other reasons. For example, you've agreed with the customer that every item is going to be sold at 10 shillings. But when you invoice, erroneously you add 0 on every item. So in other words, you overcharge by an extra 90 shillings on every item sold. So it doesn't mean that the customer is going to pay the overcharged amount. You have to issue another document that corrects the initial error. Also, when you sell using the initial invoice, correctly, invoice, everything is okay. Then you deliver goods. Some of the goods that are delivered are rejected or are returned by the customer. It therefore means that the initial invoices is inflated or overstated. Therefore, you have to issue another invoices to correct the original one, the overstatement of the original invoice. So, in simple words, a credit note is a document that is issued to correct an overcharge on an invoice. Then we also have another one called a debit note. This is a document that is used to correct an undercharge on an invoice. So when you are invoicing, you can as well undercharge the customer either through a mistake or some other reasons. So when you undercharge the customer, it doesn't mean that the customer will pay the undercharged amount. Additional invoice is going to be furnished to that particular customer so that he pays the amount that is agreed upon. So that document that corrects an undercharge is called a debit note. For example, the agreed amount, you had agreed that every item will be sold at 1,000 shillings. This is the amount that was agreed by the customer. Then now when you're invoicing, you erroneously omit a zero. So you invoice every item at 100 shillings, the number of items sold. The number of items sold. So it doesn't mean that the customer is going to pay 100 bob. No. You are going to give him an additional invoice for the undercharged 900 shillings. So that additional invoice is called a debit note. So the debit note, in simple words, is a document that is used to correct an undercharge on an invoice. Undercharge on an invoice. Undercharge on an invoice. Then we have a receipt. We have a receipt. So it's a document that confirms it's a document that confirms payment of goods or services on cash basis. So cash basis. So when you pay cash, we're using cash, then they have to issue a receipt. So a receipt is a document that confirms cash transactions. When you buy on cash basis or you pay on cash basis, you have to be given a receipt to confirm payments of a product or services on cash. So it confirms payments. It's a document that confirms payment of goods, stock services on cash basis. Cash basis. Cash basis. That is receipts. Then we have a delivery note. A delivery note. So a delivery note is a document that confirms that goods were delivered to the customer. So when you deliver goods to the customer, he has to inspect them, certify that they are okay, and then acknowledges the delivery through signing a delivery note. So it's a document that confirms delivery of goods to the customer. So every time you deliver goods, that customer must acknowledge the receipt of the same through signing what we call a delivery note. So it's a document that confirms or certifies that the delivery of goods were made. It certifies the delivery of goods. We call it a delivery note. Then we have a quotation. We have a quotation. So what is a quotation? A quotation is a document that outlines the terms of trade. It's a document that outlines the terms of trade. Outlines the terms of trade. The terms of trade, whether the goods will be sold, they allow cash sales or credit sale, and if they allow credit sales, how long do you take to clear your accounts? If they allow cash sales, do they offer discounts? How many days do they take before they deliver goods? So such a document is what we call a quotation. It outlines the term of trade. Then finally, we have what we call the petty voucher. Petty voucher, it is raised by cashier to seek authority for payment of small value. So it's a document that confirms payments of small value by the cashier. So every time the cashier is paying items of small value, he has to confirm that particular transaction through issuing a petty voucher. So that is also what we call the source document. Those are what we call the source document. Then we go to number 7. We call them books of original entry, and final ledgers, and trial balance. Trial balance.